Very special guest today. Keith Rabois needs no introduction, but for the uninitiated, he's a member of the PayPal Mafia, the former COO of Square, a founder of Opendoor, also a GP at Founders Fund, though he's recently left and is now a general partner at Khosla, a firm he recently rejoined. In the realm of Fintech, we already mentioned Opendoor, but he's also a seed investor in Ramp and on the board of a firm. He's famously opinionated on a variety of topics. This is going to be a great conversation, so let's dive right in. Keith, welcome to the program. Great to have you here.
Pleasure to be with you.
So first question, why is returning to Khosla for you a little less surprising than it might seem?
Yeah, well, I spent 6 years as an investor there where I really learned how to be a VC. And we had a really good track record and run. I think all of my partners had IPOs within my 6 years. And so I think the team as a whole was performing at a very high level. We had differentiated skills, but compatible skills. And I sort of missed like the feedback loop. David, Samir, Vinod, and Sven all have different perspectives and they made me sharper. Sometimes they caused me to lean into investments that actually I liked, but should have liked more. And sometimes they caused me to lean back. And I like to stare us around in the back of my brain, different way of doing work. We're also in the company building mode at Khosla. Think of this as venture capital and more on the venture, less focus on the capital. So that's always been the way I've worked from the time I started in technology since in 2000, from the way I worked as an operator or executive, from the way I worked as an angel investor. I was always in the venture building, company building business, and less in the capital business. It's not as intriguing, interesting, psychologically rewarding for me than maybe for other people. So I like the inputs, and the inputs drive the outputs, if that's better for me. So we were always very compatible. It was just that at the time, 2019, KV was very insular. We had an office only in one place, Sand Hill Road. We've now expanded. We have partners in New York. We have an office in Miami. We even do some healthcare out of Boston. So we're much more robust, much more broad across the globe. And so it's a lot easier to envision, the future of technology being built through deep tech at KV than many other places in the world.
Yep. Well, as at A16Z started, we had one office. Now we have offices in New York and London, maybe opening others elsewhere. Curious your thoughts. Are some funds getting too big or are they just becoming different?
Well, I think there are funds that are too big. Both there's two sides to that question. How many people and then how much capital? I think the fund size around capital is related, the proper fund size around capital is related to the strategy. So at KV, we have $500 million that we invest in seed. So we want to be the first institutional investor. We have $1.5 billion that we invest in venture capital and $900 million in an opportunity fund. Think of that as more like growth capital. Other funds have different strategies, and you can sort of infer the strategy and the focus and ideally the comparative advantage from the fund size.
Fund size is your strategy is the shorthand.
Fund size is strategy is old adage from venture capital, and there's a lot of truth to that. So, for example, at Founders Fund, the venture fund is $900 million, and the growth fund is $3.2 billion. So, obviously, the fund is going to deploy a lot of capital into some companies. Where KV, our strategy is to be the first institutional investor, high ownership, high impact, bold, early, impactful. It's a different formulation. We don't have the resources to be a super compelling growth fund. Like we can't put $300 million into a company. That's just not the strategy. But we do want to find things before other people do. We want to partner with the founder as closely as possible, help them build the team, help them select their go-to-market, help them be the consigliere for the founder. And that's a different approach. But hopefully our team and our capital is aligned. I think if you scale the team too much, you have different issues, which is everybody knows venture is a power law returns business. There's only so many companies that really drive returns in venture. Fortunately, they drive a lot of returns. And so the math can kind of work if you're in the top, let's say 10% as a venture fund. But I don't know that you can scale the venture team. I think there's a power law within a power law. One of the things that has been amazing about like a firm like Benchmark and to some extent a firm like Sequoia or Index and KV 4, 5, 6, when I was there, and hopefully 8 and so when I'm back, is all of us, 5 of us, were all driving returns. That's extraordinary. Most funds, you have 1 or 2 people, so power law within a power law, which means as you make the firm larger, your returns are going to be worse. And so I think that you can scale a firm way too rapidly with way too many people and too much capital. And that's not going to be successful for the GPs. It's not going to be successful for the LPs. It's not going to be really an exciting place to work.
Yep. And I think it's kind of an open question. Like bigger firms, they definitely are going to be different and the return profile will be different. The question is, what's the job the LPs are hiring them to do? Is it to deliver, 10x funds or to deliver good enough returns for large amounts of institutional capital? And we'll kind of see that play out. Another question on the other end of the spectrum. So you've, elected to join Khosla. You could have gone and started your own fund. Why not start your own fund? And how do you think about, obviously I've chosen to start my own fund, very small fund. How do you think about the fact there are also, in addition to new mega firms or firms becoming bigger than ever, more emerging managers starting funds? Do you think that's good for the ecosystem, bad for the ecosystem, or just the ecosystem diversifying?
I think starting your own fund is for some people, but not for most. First of all, I think venture can be a team sport, and if you start your own fund, you lose the benefits of a team sport. So I liked playing baseball, basketball growing up. I didn't play almost any individual sports. I didn't find them super compelling and interesting. And I think the same thing is true. If I started my own fund, I would want to build a team. That takes time. The things I enjoy doing are finding interesting people that can become world-class founders and partnering with them. The more time you're spending on building a fund or the administration of a fund or the recruiting for a fund, you're not pairing with world-class founders. And so what excites me to work every day is getting to sit down with a world-class founder and provide feedback, advice, counsel, and watch their eyes, sort of light up when every 100 times they say something interesting. That's exciting. That's like the reward of the business. And so if you build your own fund, in the beginning, 90% of what you do is not that. Even when you're scaling the fund, 50% of what you do is not that. At KV, 95% of what I do is that. So 95% of the day, I'm really happy doing what I want to be doing. I had, over the last 13, 15 years thought about, raising my own fund and realized that my sweet spot is not fund administration. My sweet spot is working with world-class founders and giving them advice and feedback. And that's what excites me to wake up every day.
Yep, totally. And that makes sense. And there's a lot of ways to do ventures. I think, for me, if I'd raised a very large fund and been a lead investor exclusively, it becomes a very lonely sport. If you raise a smaller collaborative fund, you can solve for a lot of the loneliest issues. I do want to talk, though, about seed investing, since you're starting to go there, and that's the thing you're most excited about and spending most of your time on. So let's start with just some of your seed investments. Maybe start with your most courageous and most expensive seed. I think you know which one I'm talking about. And then we can jump into a recent one.
Yeah, probably the most courageous seed investment was Ramp. The reason why is obviously lots of people were caught up in some other startup as investors and believe this company had momentum. Typically, being a second investor in the same space as another high-profile startup isn't a great formula. But I understand financial services pretty well. I've had the benefit of being involved in a reasonable number of companies that turned out pretty well in financial services, and realized that people at Brex didn't know what they were doing and they were going to make some classic mistakes, but that the market opportunity was clearly there. Just needed to find the right founders who had the right approach, who had the right DNA. And as soon as we found them, it was like instant. It was like, of course we're going to invest, and I don't really care what the rest of the world thinks. This is going to work. And I told people this at the time, actually. There's a emerging manager who does like financial services investing, and he didn't like the price. And I remember running into him after a Barry's class, and I said, "You just missed on your fund returner." Like I knew it, so literally knew it on day one that he had missed on his fund returner. You can ask him this. I'll give his name separately.
It wasn't me. I was at A16C at the time.
No, it wasn't.
So we
it
missed
wasn't.
on it in a different way. But
Yeah. So sometimes you know right away. Like I knew when Fair presented at YC, Semel came up to me and he was kind of sitting next to me, and he knew I'd already like led the seed round before they presented at demo day. He's like, "Why'd you do that?" I was like, "Because this is $100 billion company." And like I knew it on demo day that it was going to be $100 billion company.
yep. Yeah, and I think Ramp's an interesting example because it's both contrarian in that there's already someone doing really well in the space, but it was also expensive, which means it's not really contrarian. And trying to square those two things is kind of interesting.
That's true. That is true. It was fairly expensive. Now, when they raised them, now by today's standards, it'd be very expensive. We invested in Founders Fund, I think at 27.5 million post or something. By today's standards, that's expensive. In like 2019, the world had changed so much that what is expensive was like an open question. Over time, though, so if you compare it to like my best angel investment, which is almost surely Airbnb was 3.5 million post.
Yeah, the big difference: 3.5 million posts in Airbnb, which is is it $100 billion company or something now, versus Ramp doing great, but more expensive price. We'll see.
Rip will get there. Rip will get there, but like
Yeah.
definitely wasn't 3.5.
Yeah, and question, I want to talk about other investments, but dig a little bit more on Ramp. One thing I think a lot about is being thesis driven versus founder driven. So you said I was looking for something in the space. Like, how actively were you looking versus you met Eric and the team and heard what they were doing and then were convinced? Because I have a hard time developing a thesis and then chasing it down because it's just hard to find the right founder at the right time. If you didn't repeat it.
Sorry, we had choppy internet. Which is weird. So in any event, I'm very, very, very rarely thesis driven. I'd say once every 5 years, I have a thesis and try to find a founder who's like world class and can actually execute against that thesis. Usually, actually, if I have a thesis, I'll actually start the company myself. So Open Door, I had a thesis and actually worked really hard to marshal the resources to attack that thesis. But I had a thesis around homeschooling, which did lead to an investment in Primer. I had a very specific thesis around the proper way, the right way to compete with Brex and take over business from Amex, et cetera, Silicon Valley Bank. And so that in those particular cases, I was actually looking for founders, but this is literally once every 5 years that I have a thesis. Usually what I think of as a bottom-up investor, which is some founder walks into my office and articulates some theory of the future that I had never thought about before, and it's incredibly compelling, and they have a vision of how to execute it that really resonates with me. And I was like, great, I had no idea about this space. I had no interest in this space even, but you definitely know what you're doing, and this is a great idea. That's like 99% of like what I've done as an investor, either personally as an angel or professionally as an institutional venture capitalist.
And I think that's really, if you are really fired up about something, you can literally start it yourself or be very involved in the creation. I think that's a good question to ask about one of your more recent seed investments. It's fun to talk about Ramp because they've been successful, people who know they are. More recent one, Rome, which I think is also more contrarian, and the price is not as expensive as Ramp. So talk about maybe why you think some people think this is contrarian.
Yeah, so Rome's really interesting. Obviously, it's a space that both Eric Wu and I know a lot about. So what Rome allows you to do is basically transfer your mortgage. So as interest rates went up, lots of people who needed to move, wanted to expand their home, wanted to relocate for professional opportunities, wanted to downsize their home because children are in college, graduating, all that stuff, couldn't do it because they're sitting on this asset, like a low fixed interest rate mortgage at like 2%. And then any opportunity now would be like 7-8%. And that delta just froze people, handcuffed people in place, which doesn't make any sense.
That's really slowed down dynamism in the labor market to have everyone basically trapped in their homes because they have, it's like golden handcuffs, a cheap mortgage.
Yeah. So we saw this at Open Door. And actually we had a brainstorming session with Eric Wu, who's the CEO at the time, Megan Meyer, who runs the marketplace business at Open Door. And I had a brainstorm about how to make, how Open Door could grow in a high interest rate environment. And that led to this epiphany. Well, could you make it so that people could transfer mortgages, assume a mortgage? And that epiphany led to a startup, which became Rome, which allows people, it currently allows about 30% of the market to transfer their mortgage. And we have a strategy and plan of how to go from 30% to like 70%. The 30% of homes in the United States is a pretty large market, so not really in a rush. Yeah. But Rome was something that we did lead the seed at Founders Fund while I was there. And I partnered very closely with Eric Wu, who's on the board, to help build the company. And I still work with the company every week.
Yeah. And I think the bull case there is this is a product that sells itself. If you're selling a house and the mortgage comes with it, that's the best mortgage the buyer can possibly get. The bear case would be, is this just a high interest rate phenomenon? And will it grow, right? In any environment, what does it look like?
I think there's a strategy and a plan that would work in any interest rate environment. But right now, there's such air cover, oxygen to create value because of the spread between a low interest rate fixed loan that was taken out 3 years ago and the current interest rates that it allows you to get to scale. And this is true of a lot of financial services investments. When you don't have scale, you have a higher marginal cost, and that marginal cost has to be offset by something. So right now, we can afford a higher marginal cost of transferring mortgages, like whatever friction that we have to solve. When we get to scale, the marginal costs will come down, which allows us to succeed in a small spread environment, which is going to be pretty typical at some point. It's not going to be a small spread environment in the short term, though. Even if interest rates come down, they're not coming all the way down to 2 or 3% in any compressed period of time.
Yeah. So the kind of pushback on the bear case is, look, sure, it's a 500 bip spread today. We can get to scale, and then we can figure out how to optimize and run this when it's, a 50 bip or 100 bip spread, or even closer, right? And the bip spread being, 2% on mortgage, 7% to get new mortgage.
You can't start a startup with a 100 bip spread or 50 bip spread. There's just too many things, inertia, too many pieces of friction that go against you. So you take advantage of 500 bips, be efficient, learn to be efficient, get better terms on debt, better terms on, various other costs, lower your COGS, and then you can operate perhaps successfully even a 50 bip spread.
Yep. So much is about market timing, but you can't have a company that is only about market timing. And so basically that's the argument here is you can do both. And
you can't time all markets, but you want to ride a wave. You want to use the wave when you know there's a wave to propel yourself, to create inertia, make inertia your friend, not your foe. Almost every startup inertia is your foe. Convert that into momentum, literally in the physics sense, like momentum. Turn the momentum into a compelling advantage that will work in a more normal environment.
I wanted to start with those two examples of Ramp and Roam because it gives the audience like concrete examples of companies you've done at seed. But I also want to talk about your strategy for seed investing generally. So why do you love seed investing? And this, I think, relates to the quote that competition is for losers. So walk me through why you feel like seed is your sweet spot.
Yeah, so I believe that two reasons. One is from an economic standpoint. I think the risk reward of seed investing, if you know what you're doing, is great. And so I feel I have a comparative advantage. And the reason why is I want to invest in founders, in assessing founders. And the more metrics exist, the more products exist, the more cohorts exist. There's lots of other people that know how to invest that way. There's very few VCs who really just want to assess founders and invest millions of dollars on that basis and that assessment. That's my comparative advantage. So I want to lean into my comparative advantage as much as possible. Second is impact. So I think of a startup as initially it's a little bit like concrete in a liquefied form, which is really valuable. And then it solidifies. So when concrete solidifies, any changes require like a jackhammer. So it's incredibly disruptive, expensive, loud, noisy to change anything. So the earlier I get involved, hopefully I can help founders avoid unnecessary solidification, and therefore the probabilities of success increase. So highest possible impact avoids sort of unnecessary mistakes, if that can help, and then that leads to a higher probability of a successful outcome.
And doing seed, I think clearly, and that's where I go, like a lot of risk relative to reward. One of the big problems is time allocation. I think you've experienced this yourself, where maybe one of the biggest mistakes is just deciding which meetings to take. So how do you think about optimizing time allocation at the pre-seed and seed?
Yeah, at seed and pre-seed, the hardest part of the role is what meetings to take. Because once you take the meeting, especially if you're a founder-driven investor, I think the assessment of the founder's abilities is a tractable problem and you can get better or worse at it. But it's kind of a bounded problem. There's an infinite, or it feels like effectively in the last decade, infinite number of pre-seed companies. And so it's not possible to meet them all. And it's also not easy to scale yourself. And we were talking about the size of the fund. I think the hardest thing to teach junior investors is taste in founders. And so you can't just delegate, because what they'll probably do is revert to the middle of the bell curve, which is not what you're looking for in founders. For recruiting for employees in a company, you are worried about both tails, and you need to have a system that avoids the bad tail and highlights, the first, let's say top 10%. Founder-driven investing is all about being in the top 1%, and it's okay to be wrong. And that one skill is almost impossible to learn except by osmosis. And so you need someone who has significant abilities, skills, intensity, work ethic, and spends years watching someone who does that. So because of that, I found you cannot scale a firm very easily on early stage investing. And then the busier you become as an investor, the more pre-existing investments you have, the more one-on-ones you have with CEOs, the more board meetings you attend. It becomes your calendar just gets crowded out and becomes harder and harder to take an incremental meeting. So it's one of the areas that I struggle with. I've been an investor at VC for 11 years. I struggled this with as an angel. While I was angel investing, I was always working. So there was a scarcity to my meetings. I would typically take pitches on Sundays. and there just wasn't infinite bandwidth. But even as a professional VC, there's not infinite bandwidth, unfortunately. I thought it would maybe be easier. It's not. So I'm looking at systems that might be helpful in which meetings to take. All the mistakes virtually I've ever made as an investor are screening a meeting that I should have absolutely, at least for the benefits of hindsight, absolutely have taken. And so if someone could unlock this for me or improve it, I'm very excited. So I am working on like maybe one initiative, but I've never found a solution. I've talked to the kind of secret of the industry is most of the people I compete with are friends of mine. And I brainstormed with them about solutions to this. None of them have really great answers, by the way. I wish, but I've never heard a great answer from the people I compete with either.
Yeah, maybe walk through the solutions folks in the industry have tried for this problem. I think one is scout programs. Two is fellowships or EIRs, which is super hard to scale. And then three is being collaborative with like very small solo GPs. Like, do you think any of those have worked pretty well? And maybe you could talk specifically about scout programs.
I've experimented with almost all of them. I became a personal LP in probably 20 different funds. You know, I was going to like talk about your third example to see if that would help. And yeah, there's some signal, there's some benefits, but I still got to read all these summaries. I still got to keep track of all these funds. It's not that much better unless the GP there has a really good instinct for my taste. And some of them do. Some of them know like, oh, this is a classic like Keith founder, or this is a classic Keith company. And then you try to educate the market about like, what are you most likely going to say yes to? So at least the things you see are highly calibrated to things you kind of want to see. And that can help. That can definitely help. At the margin, there are a couple investors, either angels or fund leaders, that I think do have a pretty good intuition of like what I'm likely to say yes to. And so when they send me something, I'm probably leaning in as I review the deck and only leaning back when if I see something I don't like, versus 99% of the time it's the other way around. So you can do that. Scout programs, I think, have different issues because A, there's so many of them. B, like, do you develop the signal to noise ratio with each scout or not? Probably not. Do top tier founders really love having scouts? It's somewhat controversial. That one's a little trickier. I have done some EIR stuff. Again, you point out the obvious. Can't scale it infinitely, but creating proprietary deal flow is a very good thing. It's one of the reasons why I like to start companies. My friend, former partner at both KV and FF, Delian, starts companies. Like, it is a great idea, but you just can't do an infinite number of those either. But proprietary deal flow has worked for Founders Fund. It's worked for KV. It certainly worked for Thrive. It's a Greylock back in the day. It's a pretty good strategy. It just doesn't have an infinite scale. You can't deploy $1 billion fund just on incubations, except unless you're Sutter.
Proprietary deal flow that is manageable and durable over time is the dream. I think sometimes scout programs start strong and then the best scouts get busy, start a company, do something else. Like, there's a whole bunch of things about trying to scale these.
Exactly. People grow up, and then so you lose 2 or 3 years of like great deal flow or signal. Scouts by definition have to be very talented people, and so they do have other ambitions in life, and then they get distracted with those ambitions, and then you've lost the signal.
And some managers, they grew up, they start competing with you. They want to lead pre-seed or seed. So there's always, the answer is there's no answer. Yeah. Well, you're not worried about them competing because you might be able to win, but you are like, now you lose the ability to like have them send stuff that you think matches your
Where it started, your fund size is your strategy. And if a seed fund does really well, there's a natural tendency to increase the fund size. And as the fund size gets above $100 million, then it really does start competing for leading rounds, at least and maybe even into Series A as you get to $150 million. And so there's a little bit more competitive dynamic there versus being a really good complement, strong partner complement at like 30, 50, 60, maybe even 75 million. So and some fund managers recognize this very precisely, and they intentionally don't grow their fund size above a certain size because they want to be compatible with the ecosystem. But when you get above $150 million, you really do need to prove that you can lead a round, not just contribute to a round.
Yep, totally. And I've obviously opted for the collaborative strategy. Great. So we talked about like specific fintech seed investments we've done, your fintech, or not your fintech, but your seed strategy more broadly. I want to open it up a little bit and just talk about fintech more broadly. So a lot of pessimism around fintech. Do you think it's dead, dying, just getting starting, or just changing?
No, I mean fintech's great. I mean fintech's important to everybody. It's like a universal problem. The United States, outside the United States, so there's going to constantly be innovation. But there's two criteria I've always looked for. Been consistent for like 20 years on this. Is you need an underwriting advantage and a distribution advantage. And so a fintech investment to me is something where the founder has a theoretical, at least conceptual idea of what my underwriting advantage is to some segment of the market, and then how I'm going to distribute this in an unfair way. And the combination is what leads to great companies. So at Square, we had an underwriting advantage that was very specific, and we had a distribution advantage that was very specific. A firm has had great success with both underwriting and had pioneered a new distribution model, actually. So those two combined super well. Like it goes back to our, PayPal. We had to become excellent at underwriting. We actually started really badly and fired a couple CEOs because of it. But we eventually got really proficient at it, led by the efforts of like Max Levchin and Nathan Gettings. It became a competitive advantage, and we had a distribution advantage through eBay. The product team created more and more distribution advantage, created a flywheel that is actually incredibly compelling. That is the formula for a great company. It's pretty rare to have both underwriting and a distribution advantage. But when you find one, those are great investments. So I have another one that's growing up. There's a company, a small seed investor in at first, then led the Series A and have continued investing, called Avon, which is a wonderful financial services innovative company. It basically gives you the lower interest rates of a secured, effectively a secured loan with the convenience of an unsecured card. And the combination is incredibly compelling. Imagine 10% interest rates or something, where you have the exact same convenience and ease of use of a secured credit card.
Yep, totally. And I think, yeah, PayPal and eBay, like that's the canonical example of a distribution that play that you've been part
Well, we
of.
had to productize it, actually. So yes, there was an insight into there's a market opportunity there, but then the product team created compelling HTML buttons and then auto renews, and so we were able to like turn that into momentum. So the distribution advantage was very, very real, and that's why we had 70% of all auctions actually were listing with PayPal.
Yep, absolutely. And do you think Square was really about the underwriting? Do you think that's the core? I think of them as like a product and design, and the distribution strategy. I think it's one of the few companies, and feel free to disagree where it's worked, where the product design and onboarding were just so much better that it got them in front of a lot of people. And then over time, they scaled the other aspects of their business.
Underwriting was critical from the very beginning. We actually refused to launch the company for a while until we could get the underwriting in the right place. Like we needed permission to have complete control of the underwriting. The value proposition was instant and for everybody. And we really meant everybody. Actually, mathematical terms meant 93%, but like close enough. But we needed control of our destiny to be able to underwrite virtually everybody. We felt that if we didn't have everybody, the value proposition wouldn't work, the distribution wouldn't work. And so underwriting everybody is actually a really big challenge. Like it's easy to build models within the normal distribution. It's not that hard. But when we're talking about real world people like personal trainers that might be a personal trainer, but they don't have any physical presence, that would terrify people. So let's dial the world back before Square. If you wanted to accept Visa, MasterCard, Amex before Square, you actually had to have someone come into your store or location and actually audit you, like literally in person. And you have to get to a credit check. So we got rid of credit checks and we got rid of the manual underwriting and we made it instant. So you can apply and literally instantly be qualified to accept credit cards. So we have like examples where people would land at SFO and convince their taxi driver, this is before like Uber really took off, to accept credit cards for the first time while they were driving into the city. I had this example with a personal trainer who used to only accept checks. And I just got so frustrated of like remembering to bring my checkbook, every month, that I insisted that he adopt Square literally while we're on the training floor. So that it was like instant, immediate, and everybody. That was pretty critical. And that's really hard to do actually from an underwriting perspective. And then the distribution advantage was more through design. So what actually happened was for every Square that was in the world appended to your phone, mostly phone initially, not iPad, 1% of everybody who saw that per day signed up for Square. So the product did stand out. It became observable. It became viral in a certain traditional sense. We could actually quantify it was 1% per day would sign up for Square, which meant we had a viral loop.
But yeah, when I think about magical product experiences, I remember I saw the press release about the dongle to take credit card payments through your phone. Completely novel at the time. Read the article, clicked a link, and in less than 5 minutes, one was in the mail. And I was like, that's crazy. Like I wouldn't even known how to do this before. And now it took me less than 5 minutes.
Yeah, like you could sign up instantly. It really took about like 2 minutes. I remember when I first accepted the job, I would actually do demos for all the journalists. Like I literally like forced them
Yeah.
and would take $1 for them, which is probably like
Hey guys,
2/3
you have
of
a
the
bad business model. Try taking card payments for something. Yeah.
We actually do. What the journalists didn't totally appreciate is those dollar transactions Square would lose money on. You probably understand why. So those are very profitable to be taking $1.
Yeah. No, there's also great. We talked a lot about product versus distribution, as well as some about design. There's the saying like first time founders think about product, second time founders think about distribution. How do you think about product and distribution in B2C versus B2B? And you've been
Well,
kind of at both,
yeah,
right? Through
I
Square and some other companies.
don't think they're different. I think you always need to think about distribution. Like at the end of the day, like you need to acquire customers in an economically prudent way. I think about mostly in terms of payback, like how much friction is there to acquire new customers, and how fast does your business model allow you to pay that back? And the faster the better. So that's as an investor, from an investor lens, I'm always looking at like what's the payback, what's the payback time, and the more compelling the product is, it's typically easier to get adoption within a tolerable payback period, and then it gets better as your marginal costs go down, and you basically make more money per transaction or per something per customer, and so then therefore the payback also accelerates because you're just profiting more. But that's the key equation for me. When people pitch me, it's like, what is your payback today, and why does it get better? Show me exactly how it gets better. When? What are the sequential steps? And how does that allow you to accelerate growth?
Yep, totally. I guess you could say, for Rome, it's like, look, 500 bips. It's way cheaper. That's kind of the distribution is the product, and sometimes there are more channel-driven strategies. I just have a hard time often finding people who have compelling distribution and consumer.
Rome, the world has such a great problem that like the media is actually a distribution strategy right now, because awareness of just like I am locked in and I need to solve this. So media, politicians like to talk about Rome, and then we do have a distribution through partnerships. Our real estate agents obviously want to close transactions. They're heavily incentivized to close transactions. Rome can help you close a transaction faster or at a higher price. And so as agents communicate about that, they're very happy and excited to promote Rome.
Yep. Yeah. And earned media can be a great accelerant to growth if you find the right company with the right product moment fit. In my portfolio, I've got simple closures, help businesses shut down more easily. And you can imagine media love talking about that, right?
It's rare that earned media is a successful, scalable, durable strategy, but every so often it really works. And when you have evidence empirically that it works, then you want to lean into it. But it's pretty rare.
Yep. And sometimes it'll only work at one stage. Like I think it'll work great for this company, Simple Closure, for now through the Series A, but there's going to be other distribution channels and strategies when you get to scale.
I think that's right. I think once the world has awareness and the media has sort of covered the compelling value proposition, you can't just expect the media to write the same story over and over again. So you either have to have new products, new value propositions, or move on to other distribution strategies and techniques and channels.
Covered some fintech stuff. Generally, want to move on to company building advice. What is a barrel? Why do they matter? Why should you hire them?
So the barrel concept originates from sort of an anomalous experience that most founders have had, which is I raise capital and then I hire a bigger team. And they're all excited. They hire these talented people. The resumes look great. The LinkedIn profiles look great. And then these people join the company, and the founder wakes up one day and they say, you know what, we get less done, or we move more slowly. Why? Like, I thought like we'd have all these people, and like we should be able to do more. Or we should be able to do 3 things instead of 2 or 1. When we were 5 people, we used to do things, ship things every day. Now we ship things every quarter. And I think the underlying reason is even with the best hiring of people, most people are more like ammunition than barrels. And so you can only shoot through the number of initiatives that you have barrels. You can only embrace, fund, successfully in parallel, limited by the number of people who could literally take an idea from inception, rally people around the initiative, polish off the edges, and charge up a hill and bring everybody with them until you reach the finish line. Most companies do not have a lot of these people. So, for example, in my PayPal days, which have this incredible critical density of talent, people talk about it all the time. Of the 254 people that worked at PayPal, like headquarters, let's say, maybe somewhere between 13 and 16 were barrels, and that's like an incredible ratio. I've I've spoken about, in some contexts, in some conferences, very successful $1, $2, $3 billion companies, they might have 2 to 4 barrels. That's it. So those are the number of parallel projects that the CEO can embrace, period. And so I think this is the anomalous, the answer to the conundrum of I've hired all those people, but I get less done, or I get less done faster, or per person I get less done. And so I think I'm always, attuned to how many barrels do we have, and then we have to ruthlessly prioritize what can we invest in against the barrels. And the barrels are culturally specific too, which is really hard to recruit for. There are people who would thrive in some cultures, in some environments, some stages that would not be barrels in others. So you almost don't really know whether you have a barrel until the person's building and working. But then when you see it, you can invest in this person. You can give them incrementally complex initiatives. You can watch if they can bring the whole company with them. But then you can double down on them and fire multiple, through multiple cylinders at the same time, basically.
Yep, absolutely. Another question: company building, remote work versus in person. Remote work, good idea, terrible idea. It depends.
Horrible idea. So, I'm completely against investing in startups that want to build a remote first company. And I just watched, having built companies, understanding what goes into building companies, it's almost impossible to recreate remotely. So Peter Thiel taught me this in 2000, that when you were to build a startup, you need to build a startup based upon undiscovered talent. And undiscovered talent means that they need mentoring and learning by osmosis. Learning by osmosis is one of the most impossible things to do on a Zoom call, because learning by osmosis and that kind of craft building mentoring is unstructured, not structured. And so Zooms do not work for unstructured dialogues at all. And so if you're going to build a company with people earlier in their career, which are undiscovered, which is the formula that works, you can't do that in a primarily remote environment. You can have distributed offices where people work collaboratively together. That can definitely work and is a formula that I think we're going to see over and over again. But remote, unless you're a rare company that's really building on top of open source, you might be able to pull off a successful remote first company when you build on top of an open source platform. There's reasons for that, and I think that can work. Or you have to say, reject the Peter Thiel view of building a startup, and I'm not going to use undiscovered talent. I'm going to get very experienced people. I'm going to pay them market rates, and we have a linear roadmap. That can maybe work once in a while, but that's a very different formulation of a company.
Yep. Especially when you're kind of exploring a new idea in a new market and you need that learning from osmosis, I think very much has to be in person. If there's a lot of rote work, which to your point, that's a different theory of what kind of company should be created, maybe there's more of an opportunity. And probably
maybe so. I just rather, the only companies I'm interested in are companies that are going to be really reinventing an industry. And I don't think many of those are likely to work under that sort of different theory of a startup.
Yep.
There's plenty of other investors. If you believe in remote work, call them all, have other people fund you and wire you the money. If you're building a company in person and you want to build it kind of in the classic PayPal model, I'm happy to partner with you.
Yep, totally. I guess the one other exception would be for exceptional teams who are building a space that is culturally very remote, which open source is the one space that comes to mind for me.
Well, that's why. So the reason why open source works is you have the contributors from all around the globe typically.
Yeah.
And you're trying to corral the contributors to be excited about the layer and stuff you're adding. And so by definition, you need to corral all these people that are around the globe. So I think that's why GitLab has been very successful.
I think that's reasonable. Also, you have opinions on side projects for people within companies and whether that's a good idea or a bad idea, like Google's 20% time.
Yeah, I generally hate them. I mean, I think they're really bad. I mean, company building is really difficult. Let's start with the first premise. Building a company is a heroic effort. It's incredibly challenging and difficult. And it's extremely rewarding financially and psychologically when it works. But anything that gets in the way of the heroic effort is decreasing the probability of success. So it doesn't make any sense. Now, if a company erects a monopoly, let's say, you can definitely tolerate things in monopoly that you wouldn't ever want to do from scratch, whether it's 20% time, remote work, blah, 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 pool tables, ping pong tables, all that stuff. But that's after you have a monopoly. And very few companies become a monopoly even after 20 years. Most are still fighting every day, for their market share and innovation. But if you have a monopoly, sure, you can do all these things, but you don't want to copy. The last thing a founder wants to do is copy any practices from a monopoly because almost surely they do not have a monopoly.
Yep. And Google's about a $2 trillion company. They've had 20% time. I don't know if they still do, but I think it's pretty clear. I'm not aware of anything where that's generated $400 billion of shareholder value from that time.
No, I think you can argue Google's missed almost every wave now of innovation. And, they missed the mobile wave, at least the profitable mobile wave. They did it defensively and, maybe, deferred some issues with their search business by doing it defensively and for free. But, Apple generates all the profits in the world because Google's doing their 20% crap. Secondly, they're going to miss the AI wave almost surely too. They're struggling. They're certainly maybe at best case in third position right now. And I don't think really you see any momentum. Like, if anything, without massive change at Google, including probably a CEO change, they're unlikely to parlay themselves from third to second to first.
We're getting towards the end of the hour here. I thought we'd wrap up with some quick questions, which might be fun. First one, San Francisco, Miami. Is there anything redeemable about the Bay Area and this ecosystem, or do you think it's shot?
Well, I would discriminate between the Bay Area, San Francisco, and the South Bay. Most of Silicon Valley was not built in San Francisco. There's a window of time where some important companies were built in San Francisco. Think Airbnb, Yelp, Square. Most of those made sense for specific reasons. You think about Airbnb, like where are the markets that people travel to? Yelp, where Yelp resonate. So there's very specific reasons why those being built in a city can make sense. But if you think about $100 billion plus companies, there's only one in San Francisco, Salesforce. That's it. Nothing else. South Bay has a lot of actually very successful companies and has for decades. And I think culturally it's different. I think, schools are different, like safety is different. There's a lot of reasons for that. But I think San Francisco is incredibly overrated still today. I mean, obviously the AI wave is everybody's quote unquote saving grace. So we'll see. Some of the AI companies we've invested at KV, I think we are, my partners, the proverbial we, not me, are actually very strong AI-based investors. I think we have an incredible portfolio in AI. We were the first institutional investor in OpenAI, but I think a lot of the best investments are actually outside the Bay Area. So we invested in a new LLM in India, an LLM in Japan, for example. Obviously, the leading open source effort is in France, of all places. So I think even in AI, you can make the case that the Bay Area or San Francisco is certainly overrated. There's a monocultural disadvantage. Network effects, I mean, this is kind of borrowing and channeling Peter Thiel a bit, but network effects have positives and they kick in. They also have negatives. And the monocultural elements of, the Bay Area and San Francisco particularly can be really negative. I think there's benefits of creating companies outside the monoculture. So, for example, you see like all the defense innovation, that's definitely not in the Bay Area. It would be ideologically impossible to build Anduril in the Bay Area. You could build like
theologically, but I also think just functionally from a real estate availability perspective.
Yeah.
That's also why the innovation moved from South Bay to San Francisco. It's because housing and commercial real estate in South Bay got much more expensive. And so it's actually, to your point, I think people forget that San Francisco is a recent phenomenon. We're talking 2014, whereas, Airbnb, founded in 2007, built in San Francisco, $100 billion company. So a lot of it is just the San Francisco cohort. People forget how recent that is versus the history of being
and how narrow it may be. It may be a limited time and place, but the South Bay, you do see actually a lot of interesting companies down there. And I think culturally it's a little better. You can tell they're more missionary when they're in South Bay typically.
I have a different perspective. I think it's all big tech people who are like, don't have an interest in building something. Like, I mean, you've got Google, you've got Apple, and it's like, oh man, like these people aren't going to start something. But
no, that's true. Like, there's reasons why those companies are based down there. And like Palantir is not in the city. It's a more modern. LinkedIn was not built in the city. I think if you like really plot out what companies have mattered over the last 20 years, you can find a handful limited in time, and certainly OpenAI is the exception in the more modern era, but it's the exception. So I'm very excited about other places in the planet. I think the benefit of the internet is it spread information.
Yeah.
distribution and access to capital.
And as a venture person, I think, it's great if you can be the only and the biggest voice in the ecosystem. I think you've done an awesome job of doing that for ecosystems outside the Bay Area. So that can also work from a sourcing.
Yeah, we as a fund want to be everywhere. We want to partner with the best founders wherever they are on the planet. Like that's period. Like, we measure ourselves with, what fraction of the best founders do we work with? And of the founders we worked with before, what fraction call us first for their next company? Like we literally actually measure with the second. Like for the Max Levchins of the world, we led an investment in Slide, and then I led the first institutional round at a firm. If he starts another company, he better come to KV first, or then we'll consider that to be a negative. If Jack Dorsey starts another company, he came to KV first, he better come to KV second if he starts another company. If Sam Altman, God forbid, starts another company, he better come to KV first, not second. And like that is how we measure ourselves. So regardless of whether they start the company in San Francisco, the Bay Area, Berlin, or Miami, or New York, we want to be the first choice for world-class founders, period.
Another quick question. AI, LLMs, and fintech, hype, reality, early, or we're already seeing a lot of good stuff?
I think there's vertical use cases that are interesting, like, think of like cognition, et cetera. So can you replace an accountant? Can you replace an engineer? That's different than a global broad LLM. I don't think a global broad LLM is for most people like going to be a great idea. I think the geopolitics, that's why, India made sense. Japan made sense. Maybe Europe as an LLM may make sense. Geopolitically, AI is too important. And so countries are going to have very strong perspectives. And so I think that is a strategy. But a horizontal LLM or even a horizontal vertical like financial service LLM probably doesn't work so well. I think next generation, another investment, without giving away details, but another investment we might be excited about is something that is the next generation beyond LLMs, assuming that LLMs are not the end all be all. That'd be kind of cool.
Don't tell us about that. I don't think the world can handle something bigger than LLMs right now. Twitter, super app, super fail, especially with respect to financial services, not necessarily the platform holistically.
I don't think X or Twitter is a great super app. I think it will fail as that, but it's the most influential social platform on the planet. Every major debate that matters is on Twitter. It's not on Facebook. It's not on Instagram. It's not on TikTok. It's X. And so fundamentally, it doesn't need to be a super app. It just needs to be the place that anybody who cares about an issue debates the issue and proselytizes about the issue, and where the people who can change the world, change the policy, will read about it and learn about it. And that's what it is. And it's doing that really, really well.
In other words, Twitter, will they take on Cash App, Venmo, Zelle? No. Will they still be the place the world debates ideas?
Yeah, it's the go-to place to debate ideas, and that's incredibly important for society and will be worth eventually more than Elon paid for it. It's going to take some time, but it's not competing with Cash App. Cash App's been pretty good. I'm not too worried about the future of Cash App.
One of the most powerful lobby groups, National Association of Realtors, lost a big case. What do they lose, and does it actually matter for the housing market?
It's unclear. So real estate commissions have been, sort of plus or minus 6% forever. Like it's come down a little bit, like let's say 5.6% on average. And they are incredibly inflated by any like standard of what does a real estate agent actually do.
You look at other countries, they charge half as much.
Yeah.
Agents do twice as much volume.
In the modern world where information about homes is widely available through lots of sites, et cetera, 6% is an unsustainable commission. This happened in investment banking, et cetera. So absent some regulatory pressure, it wasn't clear what was going to drive this down. It was coming down slowly, like 10 basis points at a time. So
that comes down to about 5% on average from 6%, and maybe it's a little bit below that now.
So I think 1%, 2%, 3% like makes more sense over time, especially at the high end of the market, where like the effort of the agent is not super linear. And so, on $1 million home, that didn't make any sense. On a $10 million home, it made no sense. So in any event, I think you're going to see compression of fees, which is probably good for consumers, but like sometimes there's these weird perverse effects where costs get, like for example, in financial services, the Durbin legislation, everybody thought would bring down, debit card fees and credit card fees that merchants were paying. That had like literally no effect.
Totally. I hate realtors. It's a cartel. I wish commissions were lower. I am always worried about unintended adverse effects. And one of those may be now that it's less clear what you should be paying, maybe that entrenches some new party who has large market share and pricing power. Also, it definitely does nothing to solve the fundamental housing problem of we don't build enough homes. And so whether it's 6% or 3%, we need about 5 million more houses, and it does nothing.
Yeah, I mean, especially in geolocations like cities, blue states, the supply and demand is out of whack. The only solution to that is building more supply. That will inevitably bring down pricing. So whether you pay 2% or 3%, if pricing changes by 50%, that's much more important. So I think I don't think this is some silver bullet, magic wand, etc. It's net probably a slightly good thing, but I don't think it's so obviously like amazing.
Bitcoin, US versus global asset class. Also, a better question maybe would be stable coins. Do you think that's a killer app for crypto, or it depends?
The killer app for crypto still seems to be speculation, which is not necessarily a bad thing. I mean, a lot of the stock market is speculation. We saw this with GameStop, the Robinhood, if you watch Dumb Money, the movie, it conveys that really well. So there's nothing, people bet on football games, not necessarily to make money, but the speculation aspect. So Bitcoin is being driven by speculation. Now, can someone take advantage of the fact that millions and millions of people are connected in this network through speculation and add an application layer on top that would not have been easy to build or maybe even impossible to build from scratch? Yes. And that's what would be most interesting is who takes advantage of all these connected nodes and says, aha, I know what to do with this. But that hasn't happened yet, certainly not in the United States.
Yep. And that's an interesting take, basically, that speculation clearly has been the vast driver of, call it value for lack of a better word, but it could bootstrap a real network.
That's exactly right.
Some inklings around stable coins too, but it's early.
I'm not dismissive about the value of speculation. I think it's perfectly fine to gamble with stocks, perfectly fine to have meme stocks, perfectly great, to bet on football games per se. Like, I don't think there's anything wrong with this, but I think at some point, maybe someone can connect the dots because the nodes are already built. And there might be something compelling, but we haven't seen that. And that's why it's so fragile, because when you're speculating, look, you can look at the transactional volume when, like, for example, when the stock market goes down, what happens to Robinhood?
And then I think last one, fun one, beyond berries, what's your full stack for health from diet, sleep, exercise, lifestyle?
So sleep's the most important. It's the foundation. People sometimes obsess on everything else, but they don't fix the sleep. You need like close to 8 hours sleep. The best thing you can do is invest in 8 sleep, which I did, and I highly recommend it. Like almost everybody I know sleeps on 8 sleep. It'll cool your lower body and create a lower core temperature, which will induce better deep sleep. So sleep is foundational to performance. It's foundational to health, and it's foundation to athletic performance as well. Second, obviously nutrition. You can't outwork a bad diet. Again, people like to focus on berries and all these other things, but if you want to be healthy, wealthy, and happy, you need to eat well. And I think there's more and more recognition of that. Still, I think we're decades behind where we should be. I think the government misled a lot of people in the 1970s and 80s, which is why 70% of Americans sort of borderline obese. But the better you eat,
self-acknowledgedly, they literally changed the food pyramid.
The better you eat, the better you sleep, things will kind of start coming into place. Then, of course, you can layer on different programming for different goals. Like, people have different goals. Sometimes it's performance-based. If you're an athlete, it may be performance-based, power-based. Sometimes it's endurance-based. I think you can improve your lifespan through fitness programs, like lowering your resting heart rate, improving your 2-minute recovery, will improve your lifespan, certainly on average. I think there's things you can do, like if you care about cognitive performance. I think your brain and your body are connected in ways that many people don't appreciate. It's kind of an old school thought, dating back to the days of Aristotle, but it's actually true. And we're going to have more and more evidence of that. So if you want to be a high performer at work, the best thing you can do is train your body in the right way. And then, lots of people have aesthetic goals in life. There's nothing wrong with that. People go shopping to look good. There's a reason why they spend money on dresses or shirts or whatever. And so, training can be a part of that. So my berries program does improve life extension. It is somewhat vanity driven. It's fun. It's actually increased my exposure to people, and I've funded, founders I've met there. I've hired people I've met there. It's increased my musical taste. And it's the only time I put my phone away all day. For an hour, I'm way too busy to be distracted. And so it's really healthy to not be on your phone, and have the discipline that it creates is really effective, and it's incredibly efficient. You get weights, which Peter Thiel's of the world. You got to have muscle mass. That's how you counter aging. It's really good for weight, and it's really good for improving your resting heart rate and your 2-minute recovery. Get them all done in an hour. Listen to music and meet interesting people. What else could you want?
Yep. All right. Barry says checks in the mail. So they thank you as always.
They better be.
Alcohol, sometimes, never, as part of a lifestyle.
Oh yeah. I mean, I'm like religious about my Apple Watch. I'm connected to the maximum. You can only connect to 50 people, and I keep hitting the limit. I think it creates accountability. So when I see my friends working out, it makes me more likely to work out. When they see me training, I think it improves the likelihood that they, work out. So that's really healthy. It's a great way to stay in touch with people, like you haven't seen in a while. It's a lightweight way of tracking what your friends, family are up to. I do measure. I believe strongly, like if you don't measure your sleep or your workouts, you can't improve them. And I use some of the feedback loop of like things like HRV as a way of knowing, does my body need a little bit more rest, or is it ready to trickle down? So I do use it as a brake and as a gas pedal. The metrics I get back, I have obviously stitched it all together, and they give me guidance of like, hey, go ahead, like push yourself today, or just do a normal workout. And I think that stuff is scientifically valid.
Yep. Yeah. HRV tracking has been the most interesting and surprising for me if you're about to get sick, you can see it drop before you notice it.
Oh, absolutely. Almost everybody back when COVID was a thing. I never got COVID, but when my friends did, anybody who's using this always saw the HRV change first before any symptoms.
Well, thanks so much for coming on. This has been awesome. Look forward to hearing about the next seed deals you do now at Khosla. And otherwise, I'm sure, folks will see you around in the ecosystem.
Pleasure. Thanks for having me.
Really enjoyed that conversation with Keith. I don't really know how to summarize it because we covered so much ground, everything from why he loves seed investing, what's next in fintech, advice for building companies. If there are questions you wish I'd asked, feel free to put those in the comments. Maybe we can cover those in the future or in a follow-up episode. Also, if you like this conversation, I've got a bunch of other ones with founders, builders, investors in fintech. Until then, catch you next time.